But moving forward and discussing a lot more stocks with Siddharth Vora. He's, of course, joining us from Prabhudas Leeladhar as well. Good to be speaking with you, Siddharth. Just to begin with, marking a few more stocks which are actually doing quite well. And you have Bharat Dynamics that comes to mind because that stock is, I think, trading higher right now by almost 5%. And you also have G Shipping doing well. Z Entertainment is in focus. Actually, on Z Entertainment specifically, is this a stock that you probably cover, Siddharth, or have a view on?
So from the PMS side, actually, we're not looking at Z Entertainment at all. And given that we use purely quantitative strategy for evaluating, right now, Z is not even among the top 150 ideas that is being screened by our quantitative models. So on the institutional side, we do cover it, but not on the buy side.
What have you added recently, as in not the stock price? The idea is to understand the thought process of where you're finding value and hence building up positions.
Sure. So I think the last 20, 30 days have been very, very good for the portfolio as well. Some big winners for us since the last rebalance in, say, mid-April have been Cochin Shipyard, Musgao Dock, M&M, Hindustan Aeronautics, BEL, Indigo, and Honeywell Automation. So over and above some of these ideas that I just mentioned, we also have a significant overweight in the whole metals pack. So I think the whole auto, defense, industrials and metals exposure has done really well for the portfolio.
Not only did they come out with very good set of numbers, but also the commentary last evening in the call, after almost several years, in fact, they've conducted a call of that sort. What are your thoughts on the valuations of some of these defense names, which have run up quite a lot, but do they give you good visibility and comfort even from here for next 2-3 years?
So again, our idea is to be using our quantitative models to be able to look at all these stocks, not from a lens of valuation alone, but rather a combination of valuation, growth, the quality improvement that we are seeing in their balance sheets across a cycle, along with what the sectoral trends are also showing. So we want to be invested in stocks that are from a relatively stronger sector rather than those stocks that are from a relatively weaker sector. So I think combining all these factors together definitely gives us comfort to hold some of them till our models suggest otherwise.
But Indigo has recently announced their starting of the international routes. Up till now, they've been the big daddy as far as the domestic airspace is concerned, massive market share there. Plus, they've aggressively started ordering new aircraft. What do you make of the prospects for Indigo? And this is the only one which is making some decent money on in the space. Otherwise, everybody else is bleeding. Can it get further re-rated from here in the next few years?
So the thing with Indigo is that we've been holding it for the last close to 6 months now. And I think the broader thesis on Indigo is obviously extremely positive demand dynamics. At a country level, we're seeing unparalleled air traffic. At the same time, a lot of weakness in competition, a lot of issues with other airline groups. And given Indigo is the best managed, most efficient airline company gaining market share out of weakening competition, I think structurally it's very, very well positioned, I would say. So I would not worry about incremental re-rating from here, given the tailwinds are very, very deep and long.
There seems to be the big takeaway from this earnings season has been rural recovery, because that's something that all the managements, right from paint companies to your consumer durable companies to FMCG, have been pointing out. To play this theme and the fact that monsoon is expected to perhaps hit us on May 31st itself in Kerala, how are you churning your portfolio to make sure that it's poised to capture that rural recovery theme?
So I think we have quite an overweight on the auto pack, the domestic focused auto pack. And I think auto is, for us, the best way to play the rural recovery, given strong volumes, improvement in margins, a lot of new product launches, and a very, very solid traction to the new product launches. So I think with a good monsoon expected as well, I think names like Maruti, M&M, TVS, Bajaj Auto, Hero Moto, the entire pack is likely to be a clear beneficiary. And obviously, there is an increase in the average selling price and improvement in product mix across the entire auto chain. And I think that with the capacity expansion that all the auto majors have announced should do much better in terms of, reducing waiting period, improving execution. So we want to play it via the auto route because there is a lot of demand visibility there.
Auto ancillaries, some of the auto anch, Varick for example, Endurance Tech doing very well. Which part of the auto anch space are you playing in your portfolios?
As of now, we're not exposed to any major auto ancillaries. We are playing with the OEMs as well. We are exposed to the OEMs.
What about within auto? Have you started building a position in any of the CV players? They have been quiet. The two-wheeler and passenger have been doing well, but now the word is that second half of the year actually CV cycle will start improving. Do you have it in any form, either CV financier or CV OEM?
We have exposure to Tata Motors for the last close to 7-8 months now. But other than Tata Motors, nothing else yet. I think Tata Motors gives us a much broader play rather than just CV, but the cyclical uptick in the CV cycle also obviously benefits Tata.
Fair enough, that has quite a bit of diversified portfolio right from the luxury end to the commercial vehicles.